which is clearly very important right now. The UK election have thrown a hung parliament. Andrew Holland now joins us, CEO of Avendus Capital Alternative Strategies. Andrew, good morning. So the news from your country is that there's hung parliament. Do you see any kind of impact on, of course, your home country's market and also your adopted home country's market?
Well, at least my adopted home country market is a lot more stable than my homeland. But you know, I just don't know what the Conservatives are doing. I mean, they're taking these big gambles and just losing them. I mean, I think already the knives are out for Theresa May within the Conservative Party, and you know, we could have a new leader by the end of the weekend. So, you know, let's see how that plays out. But obviously, from a UK viewpoint, it does weaken you know, their hand in the Brexit negotiations and makes Europe a lot stronger. You know, I think everyone's just kind of having a sneaking laugh in Europe about what's happened in the UK, you know, following Brexit and these elections. So I don't think it has a big impact in terms of global factors or India in particular. Obviously, there's going to be companies like, you know, IT and some companies which are you know, positioned in the UK where obviously translation of earnings will have an impact, and I'm sure they haven't hedged this. So, you know, there could be a little bit more kind of downside in certainly some of the IT companies and pharma companies who are positioned in the UK.
Okay. Morning, Andrew. Thank you very much for stopping by. But in a way, this is Empire Strikes Back. The EU prevails over Fissiparis or challengers, as it were. Does that alter how people will distribute funds, more money going to Europe, less worries about, you know, markets of people selling to Europe? Would you back the Europe companies that sell to Europe?
Yeah, I mean, obviously what it means is that, you know, the kind of fears about Europe disintegrating is probably off the table for some time now. So that puts Europe in a stronger position. And, you know, I think we've seen some of the data coming out of Europe has been very strong in terms of GDP data. So I think that will continue. I think for the UK, it's got to try and pick up itself and get some stability. Because, you know, a lot of challenges, you know, whether it's financial companies wanting to pull out, it's going to rear its ugly head very quickly now. So stability is what the UK needs, and it just doesn't have it after these results.
Yeah. What about flows? How does it alter the flows into various markets, various equity markets, according to you right now?
So I think what will happen is that you know, if you take a weaker sterling, then what that means is actually it's very good for FTSE type companies because they have a lot of overseas earnings. So you might not see a big kind of shift away from the UK markets because the earnings growth will be quite strong for those companies. I don't see a big shift in terms of flows because of what's happening in the UK, but I think what you'll see is probably areas like the UK housing market taking a hit in the very short term as investors try and work out what's going to happen to asset prices, particularly in real estate over the next 2 to 3 years, given what's happening in the Conservative Party. So, but in terms of flows to the markets, I don't see there's going to be a big change from the UK.
Okay. The other important issue, Andrew, you know, on which I want your comment. You have seen so many market cycles. What's happening with IT? You know, Infosys down another 3% right now. Do you get a sense that this is more than just a normal correction and, you know, normal business issues, and there's serious risk of massive de-rating even from here on in the entire IT sector?
Well, you know, I've been very negative on the sector and said that, you know, I can only look at it from a dividend yield perspective, and dividend yields, you know, need to get towards 10% for me to want to buy it. So that would still mean a further de-rating for the sector. But because that growth has just gone away, it's become a commodity. You know, these companies have to reinvent themselves, and been trying to do it for the last 2 to 3 years, and it's not worked. And it's very, very painful. You know, for this transition, and that's what's playing out, and that's why everyone's being frustrated. And you know, I was interested to see that, you know, they've abandoned their 2020 vision, which means, you know, if they're not going to go for those kind of revenues in 2020, then, you know, give shareholders their money back, because, you know, you're just trying to realign the business. And if the realigning business is not going to mean acquisitions, which you would need to get to that 2020 vision, then you know, give it back to shareholders. So that's what I would be looking for the IT companies to do. It's the only game they have in town, actually.
Oh my God, that's saying a lot. Just give away your cash. But yes, a lot of people would read the Infosys news as a business decision as well, and not just a corporate governance decision. That's the big worry. That's an overhang on the other IT stocks as well. But Andrew, since we have you with us, what's your call on the markets itself? I mean, at 9,700, would you worry? Would you start taking short positions, or at least start taking some money off the table?
Latter, I've been worried since
Yes.
9,200 because of liquidity in markets, and it's just made me look. They made me look very stupid, but that's fine. That's what liquidity does. You know, there's a range of issues out there which, you know, the market's kind of ignore because of liquidity. One day it won't, and we'll see that big correction, and it'll be painful, like it was in May. But, you know, for our fund, for example, we're around about 65% hedged. So, you know, we know the risks are there. We just don't know the timing of when they're going to hit.
But where do you take shelter? I mean, everybody is worrying about liquidity overwhelming valuations in such an emphatic manner. Is there a place to hide? Would it be FMCG? Where?
It's only FMCG. I mean, you know, that's the sector which we've, after a long time, you know, become more enthusiastic about, despite the kind of valuations, because GST is a huge game changer. There's a re-rating of this sector. So, you know, you can't hide in telecom, you can't hide in pharma, and you can't hide in IT. So, and you can hide in FMCG, but you also get a re-rating as well. So that's the big switch we've been making for the last few months, and that's what we're going to continue to do.
Andrew, what could trigger a correction? That correction we've all been waiting for. So many retail investors want that correction to buy into the market. Global markets are clearly not providing a big enough dip. In fact, the biggest correction that we've seen since the rally from 7,800 has been to the tune of just 200 points in the Nifty. So from here, what could trigger a correction according to you?
Well, there's many factors out there, but the one that I'm kind of focusing on is China. I do think China is slowing a lot quicker. I know, you know, whilst the headline news was saying China is looking to buy, you know, US treasuries again, I only see that as a way of depreciating their currency. I think they have to depreciate themselves out of this slowdown in China. Now, whether that's going to be by, you know, slowly getting the currency to depreciate, or do what they did in 2015 and take a hit on the currency, I think one of the two is going to happen, and they're starting off slowly by buying treasuries and depreciating the currency. But I think they might have to take a more bolder step than that. So China would be the one which I think could bring global markets back to reality in terms of that demand in China is continuing to slow at a faster rate than people think.
All right. Well, just a last word on interest rates itself. You know, there is, as you may have read in the papers and on our channel, a huge amount of pressure coming in from North Block on Mint Street to cut rates. Something you've been advocating, Andrew, and you were right on that. The pressure is now building. Is there an interest rate play now? You know, once again, a relook at NBFCs or private banks or realty stocks, housing finance companies?
No, you're right, Latter. I mean, you know, you know, for both the finance minister prior to the monetary policy and the RBI governor saying we're in a slowdown, I don't know what he's waiting for. So I think 25 bips before the end of August is definitely on the cards, and that will give, as you say, a fillip to. I would go more with private banks and housing finance companies than anywhere else.
Any contra buying that you're doing in pharmaceutical names?
Any contra buying in pharmaceutical names? No, none at all. Listen, their pain is just starting. Okay. Just think about IT 2 years ago. Pharma's just starting.
Okay. So any bounce should be used to sell into, perhaps, and there is more de-rating left for pharma names.
Listen, pharma has to, again, do what IT is trying to do now, been trying to do for the last few years. They've got to change the business model. The business model is broken. Those days of decades of generic growth is gone. It's not happening. It's not coming back.
All right. Andrew, thank you very much for making this stop with us on a day when your country is going through an important election and deciding on a hung parliament. Well, your take is that it's anyway not going to impact fund flows, but thank you very much for stopping by. Well, the markets at this point in time not looking like in a very, very rosy spot. It's just about, okay, no, it's corrected a bit. It's not 0.25% down now. The Nifty and the Sensex have pulled back and the mid-caps are in the green at this point in time. The Nifty Bank is the one that's made maximum gains. And I think Yes Bank has pulled up. So have some of the other banking stocks as well. HDFC Bank is lending its shoulder 1/3% higher. Kotak Mahindra Bank 1/3% higher. So markets roaring back at this point in time, but we will have to see whether this holds or whether this will be taken as an opportunity to sell.
Well, we're just probably making